Hi guys, I'm Manu and welcome to another episode of Sweet Money. After today's video, you will know the following. What is a capital gain? Which activities and line items are added to the capital gain calculation? What if I sell an asset at a loss? What is depreciation and should I claim it? How is capital gain taxed in Canada? And why the capital gain tax is in limbo? In addition, as a bonus feature, I will explain why if you have a very profitable private corporation, a capital gain can be a very powerful tool. And as a second bonus, I will explain how you can save $1 million worth of capital gain exemption when selling your business. So a lot of information coming your way. Sit tight. See you on the other side. Capital gain taxes are levied on earnings made from the sale of assets, like stocks or real estate. Based on the taxpayer's income level, the tax is computed using the difference between the asset sale price and the acquisition price, and it is subject to different tax rates. A very simple example is if you purchase a cottage for $500,000 and you sell it a couple of years later for $600,000, you have earned a profit of $100,000, which is called a capital gain. Now, if you're earning a salary of, let's just say, $200,000, and now you sell this cottage, this tax that will be levied on you will be at the highest tax bracket. However, if you don't earn any income and your only income for the year was a sale of this property, you will then be taxed at a lower tax rate. Oh, and by the way, from a tax perspective, it is beneficial to earn capital gains versus income. For the very simple reason, you get more tax exemptions on a capital gain versus your income. So now that you've sold your asset, you're probably wondering which line items, which expenses can I include in this calculation? Firstly, it's the cost of acquiring the asset or the cost of creating the asset. Number two, it's the expenses incurred, which are known as incidental costs, such as your commission. Number three, the cost incurred in enhancing the asset. Coming back to that cottage, if you decide to fix your patio or add an extension, that is an enhancement to your asset. Number four, legal or professional fees. Number five, the incidental expenses incurred during the disposal of the asset. For instance, if you have to travel to your cottage, then that would be an expense which is added to your ACB, the adjusted cost base. And note, intangible assets such as goodwill also qualifies for capital gains when sold at its fair market value. Given the real estate market that we have in Canada, you might be wondering, what if I sell my investment property at a loss? Well, in that case, what you can do is take that loss and go back up to a maximum of 3 years and apply it against any capital gains you had recognized. Or if you don't have any capital gains to apply it against, you can take it forward indefinitely until you do earn a capital gain. Guys, if you want a video on the tax rules surrounding the principal residence as to when it triggers a capital gain and when it doesn't, make sure you let me know in the comment section and I'll make a video for you guys. All right, peace out. Love you. In addition, the source of the capital gain is irrelevant. And what I mean by that is if in 2022, you earned capital gains of $50,000 selling stocks and bonds, but then in 2023, you have a capital loss of $30,000 selling your property, you can now apply that $30,000 loss from your property against the $50,000 gain that you earned by selling stocks and bonds. Therefore, the source of the capital gain is irrelevant. You may have heard of the term depreciation. Let's get into it. Depreciation is an accounting term. When it comes to taxes, the synonym is CCA, capital cost allowance. And capital cost allowance has tables which are called classes. So each asset falls in its own separate class. For example, class 14.1 is goodwill, and it is depreciated at a rate of 5%. So if you have goodwill of $100,000, your CCA, 5% of 100,000, can be a maximum of $5,000. Another example is Class 16 taxis and rental vehicle, and the depreciation rate, or the CCA rate, is 40%. About a minute ago, I said you can claim up to $5,000. And what I mean by that is if you have a profit, for instance, of $3,000, you cannot claim CCA of $5,000 and show a loss of $2,000. So the most you can apply on your taxes will be the $3,000 to bring yourself to zero. You cannot use CCA to go into a loss. A question I get asked a lot is, should I be claiming CCA on my personal income tax? And I know you guys hate the answer, but the truth is it depends. For instance, if you're in a high income bracket, it is beneficial for you to claim the CCA because you'll be paying taxes at an average of about 48% on your rental income, but you don't want that. So you claim your CCA and you eliminate, or try and eliminate, as much of the rental income as possible. Now, if you're in a lower income bracket, perhaps it may not be worthwhile to claim the CCA, because if you have too many losses, then it might trigger an AMT, which is called alternative minimum tax, which can basically void the CCA that you had tried to claim. I know it's a little convoluted, but once again, speak to your accountant. And a second question that pops up, which I think is a brilliant question, is if I claim CCA, and then when I go sell the asset, won't my capital gains be greater? And the answer is yes. If you claim CCA, you are now reducing your adjusted cost base, which is your acquisition cost, which in theory will increase your capital gain. However, I told you earlier that the tax exemptions on your capital gain are significantly higher than the exemptions you receive on your income. Therefore, it might be worthwhile. And I'll say it again, please speak to your accountant.
Mr. Speaker, Canada makes every single one of us a promise. If you work hard, you get a good life. That promise, like everything else after 9 years of this NDP Liberal Prime Minister, is broken. Will he call a carbon tax election so that we can bring home Canada's promise?
Once again, Mr. Speaker, we see the Leader of the Opposition pushing a brokenist vision of Canada that is simply not aligned with the reality. Yes, Canadians are struggling like people are all around the world.
Mr. Speaker, brokenist. It's not even a word. He's even breaking the English language. Oh my goodness.
Great. Now this segues perfectly into how do we calculate our capital gains tax. But before we get into that, here's a quick story. On June 25, 2024, our beloved government has introduced a new tax bill which reduces the tax exemption. And what that means is your tax bill can increase by up to $20,000. That's right. The government will put their hands into your pocket and take an additional $20,000 and say thank you. So please feel free to send our soon-to-be ousted PM a postcard telling him exactly how you feel. All right. Here's an example. Purchased a cottage for $600,000, incurred $60,000 of real estate commission fees. You paid $40,000 for repairs, staging, and travel to your cottage. Now, the cottage you sold for $1.3 million. Your adjusted cost base for $700,000. You sold it for $1.3 million, which gives you a profit or capital gain of $600,000. Now, as per the new rules, the first $250,000 of your capital gain is exempt from taxes at a rate of 33.3%. So from your $250,000, we remove 1/3, which is $83,250. The remaining balance of $166,750 is now taxable. Now the remaining 600 minus 250, $350,000 balance is exempt from taxes at a rate of 50%, is $175,000 is now taxable. So your total taxable amount is your $166,750 plus your $175 is a total of $341,750. And this, my friends, puts you in the top income bracket. Now, depending on which province you live in, your rates will differ, but a rule of thumb, let's go with 48%, equals to $164,040 of taxes. Now, I had mentioned in the beginning, this tax rate is in limbo. And let me tell you what's going on behind the scenes. There's never a lack of drama when it comes to our government. So this rule, this exemption, this reduced exemption went into effect on June 25th, 2024. This bill is supposed to pass in Parliament right around now, which is the fall of 2024. However, the Liberal government at the moment is extremely unstable. It's a minority government, and the parties that are supporting them to keep them in power have put some conditions that if you don't meet our conditions, we will revoke our support, which will trigger an election. Now that you have the backdrop, two things might happen. Number one, there might be an election, which means they won't be able to pass this bill. And number two, if this bill does get passed and we do end up having an election, the new government might scrap this new tax rate. So yes, it's in effect, but it's quasi, if that makes any sense. If it doesn't, it's okay. I promised you guys some bonus features. Here's bonus feature number one. If you own a private corporation, which is called a CCPC, and you are generating more profits than you need to earn your living, then what's happening is your cash is accumulating in your corporation. Now, if you invest this cash, and every dollar you earn of interest and dividends, it will reduce your small business deduction by $5. Which means if you end up, and your small business deduction is $500,000. So if you earn, let's say, $100,000 of interest expense, your small business deduction will disappear. And your small business deduction is a tax rate of roughly 12.5% to 12%, depending where you are. So you don't want your cash just sitting in a checking account collecting dust. That's the worst financial decision you can make for yourself. So what you can do is purchase stocks which only pay you through capital gains. And when they pay you through capital gains, mean they appreciate, but they do not provide dividends or interest. And because you're not providing any dividends or interest, you will not reduce your small business deduction. Bonus feature number two. If you decide to sell your business to your children or to a third party, the capital gains that you recognize on the sale of your business, $1 million can be exempt from that capital gain. I'm not talking about the exemptions here. We slice off $1 million and then we start applying your exemptions. Absolutely. Let me repeat that one more time. If you sell your business for $3 million, you have capital gains of $2 million, we will take away $1 million and your tax exemptions will be applied to the remaining $1 million. Now, in order to qualify for this amazing tool, you have to do certain things. Number one, you have to start prepping for the sale of your business at least 3 years in advance. Speak to your accountant and they will walk you through what needs to be done. But the gist of it is, A, you have to sell your business at fair market value. B, you have to sell the shares of your company and not the assets of your company. And C, you have to own the business for a minimum of 2 years. There are other criteria as well, but that could be another video for another day. And remember, it all starts with a simple conversation.